All right, so today we're here with Jason Paull from Fairway Mortgage to talk about the hot topic of the day. So what have you been doing in the lending world these days?
Super busy time right now. Not only do we have the springtime home buyers that are coming out, but with the stock market correcting over 10% last week, it dropped mortgage interest rates. So a lot of past clients or people I haven't worked before are reaching out right now just to see if it makes sense to refinance. People as early as last year or late last year are actually benefiting from a little bit lower interest rates right now. A lot of them, though, we need to spend a lot of time to make sure it benefits them. A lot of online lenders are just touting the lowest interest rate possible. There's a lot of fees that go into doing a refinance that you need to be careful of.
So how do we determine what the total fees look like? I mean, we're talking about lending rates and then we're talking about fees added on top. How is it that a person is supposed to make an apples to apples comparison?
Yeah, great question. So I use a program, it's called a total cost analysis, and I can put side by side multiple options. There's also an APR rate, which is, you'll always see the interest rate, and then they also need to quote you an APR, which is annual percentage rate. And it's basically annualizing all of the fees that go into doing the loan on top of the interest rate. And that'll give you a little bit better apples to apples comparison.
And so is any lender, even if they're online, supposed to provide that APR as part of the business that they do?
Yes, they need to. There are some fees that do not affect the APR. Okay. And so you do want to see the full list of fees. Most commonly, you'll get a loan estimate. And that would be your best bet to get a loan estimate from multiple lenders to be able to compare apples to apples.
Okay, and so is there another advantage to people? I mean, we've seen the real estate market has obviously appreciated over the last year or even the last 2 years. Does a homeowner need to see a huge benefit in the price of their home going up in order to refi, or does that make much of a difference to when they're doing a refinancing?
It just depends on their situation. So how much you put down obviously is going to be a big factor. So let's say you bought last year and you put 15% down, you may already have the 20% necessary to drop mortgage insurance. Okay. A lot of this depends on the program that you actually did. Some mortgage insurance never drops off, some automatically drops off once you hit that point. So really just giving us a mortgage statement is the best spot to start, and just look at running numbers for you and seeing what makes the most sense.
I love the analysis that goes along with that, because every situation is going to be different. You can't just go across the board and think, oh, you can refinance now because maybe the fees aren't there, maybe it's too expensive, you're not going to save enough on a monthly basis. But what about other strategies you're seeing? Are you seeing people being able to maybe shorten up the time on their loan? If I've had a loan for 8 years, for example, can we shorten those up and try and come out ahead in the way these markets have dropped?
Yeah, for sure. That's a great way to look at it. So for most people, whether you bought last year or 3 years ago or 8 years ago, we don't want you to move backwards. And so that's a big part. We talked about fees earlier. Typically, some lenders will add all the fees to the loan, so now you owe more. So it takes you a time period to actually recoup all of those costs and see a benefit from the refinance. A lot of my clients, if we have the income there, and if they're okay with a little bit higher payment, we'll look at doing a 20-year or 15-year. That way they're moving forward. Okay. Even if we do move back to a 30-year, I still want to show them the option, because the point is to drop your payment by getting a lower interest rate. So let's say you save $200 a month. Let's take that $200 and apply it back towards principal. So then you're not moving backwards in time to a 30-year. Let's say you bought last year, you're probably going to shorten it up to like a 25-year loan. So we definitely want you to benefit and not be adding too much, because nobody lives in their home forever. That's not really our generation. Statistically, you're not going to live in there. The number does keep going up just because some baby boomers are staying in their house longer, but typically, the first-time home buyer isn't going to be in their house for more than 7 years. And so we don't want you to have to stay in your house for 10 years to see a benefit from the refinance. A lot of times if we can cover the costs and maybe take a little bit higher interest rate, it makes most sense.
So by having a conversation with you about what their plans are, how long they plan to be in a place, you could put together a scenario that'll best benefit them. Even if it's not the lowest interest rate, but you're able to save money and cut time down on the loan, they're still coming out way ahead.
Right. And it's not necessarily how long you're going to stay in the home, it's how long you're going to have the loan.
Okay.
Good point. So like, if you bought 2 years ago, you may still be planning to stay in the house for 10 years, and you may have told us that 2 years ago, but if we're going to refinance, you only had that loan for 2 years. So if you paid points 2 years ago, well, you haven't had the loan long enough to recoup that benefit. So it's it's hard. We can't predict the market. We don't know our rate's going to go lower. Some people say yes, some people say no. The Fed's trying to control things as best as they can, but it'll depend on what the stock market does over the next year, what happens in the election, what the world economy does. So yeah, it's kind of hard to tell, and I don't have a crystal ball that will give us that answer.
Right.
But
I think Jason makes a good point here, and I think that's a point that some people may forget, is just because it's the U.S. 10-year Treasury or U.S. 30-year Treasury, it's not just controlled by what goes on in the U.S. These are global markets. So if things get really bad in Europe, or they get really bad in Italy, for example, you could see more demand coming from Europe buying our bonds, forcing rates lower. Doesn't necessarily mean that things have gotten worse in the US as far as the virus is concerned, but you will continue to see volatility. And so we don't really, as much as the Fed wants to try and control the rates, it's up to the market to control what those rates are going to do. So the more demand for bonds and people going to safety, you're going to see more pressure on rates to the low end. So I don't know if you feel like making a prediction. I doubt it, because I don't either. But I just don't see rates probably going anywhere for a little while. You're not going to see them go up in the near term, I don't believe, especially in an election year. You're not going to see the Fed reverse course all of a sudden after just lowering interest rates this week.
yeah, we may see a short-term rise in interest rates if the stock market does pull back to its highs. But I think right now it's trading in a range that we'll actually see it go back down a little bit. So at least that's the economists that I follow, and anything could happen, and they could cure the coronavirus tomorrow, and then that would obviously have a positive impact, which typically is the opposite impact on interest rates. So it's kind of we never want to wish for anything bad to happen. But
I think that's something worth mentioning, is that the reason the stock market is so volatile right now is because people are afraid of going out to dinner, or maybe going to a movie, or even getting on an airplane these days, or going on a cruise. We've seen so much news in the press about this, so we're anticipating that earnings are going to get hurt by less demand. We have primarily a service-based economy in the U.S., and so as you use less of those services, you'll start to see pressure on earnings, and therefore the market has to adjust. It has to play a different multiple for those same lowered earnings, which is why we've seen the kind of negativity that we've seen in the market. But as a homeowner, or as someone that's looking to either buy or to refinance, I think it's a phenomenal time to get into the market and to find out what's out there for you. And so can we talk a little bit about the pressure that the industry is feeling right now, and some advantages that you can help offer in that kind of environment for borrowers?
So right now, like I said earlier, we're in the busy spring buying season. While we do refinances, we are a purchase-focused company, which I really appreciate because it allows me to support partners like you. And so even last night I was on the phone with some borrowers who they had been pre-approved through an online lender. They got under contract, 30-day purchase period, which is really normal in our market. They went back to their online lender and said, hey, we're going to close in 30 days. And they told them they needed 45 to 60 days to close that loan. Wow. Not really something the listing agent wants to hear, or a borrower wants to hear. So I got the phone call, and we're totally able to close it within the 3 to 4 week period. Our CEO has been pushing everybody to work on purchases first and then do refinances second, just because we're not bound to a closing date on a refinance. We can target a date, and if it's optimal for the borrower, that's great. But if it gets pushed out a week, then nobody's going to lose a house or anything like that. So
I think that's amazing. An interesting point that he makes here. As a listing agent myself, once you get under contract, we've got a very emotional time for both the seller, who's nervous about getting his house sold, about the buyer. And the last thing we're going to need in a transaction like that is for a lender to say, oh, nope, sorry, it's going to take an extra 3 weeks perhaps to get this thing closed, because you will see offers not accepted as a result of that, and they'll go find someone else that's going to have a shorter time frame to get these things sold. People get nervous, it's an emotional time, and the volatility of interest rates isn't going to help. So I think I'm really glad you mentioned that, because from that kind of negotiation standpoint, we're going to hold people's feet to the fire when we get an offer and they have a closing date on there.
Yeah, absolutely.
Well, Jason, thank you very much. Thanks for letting us borrow your conference room today. I know you're busy, but I appreciate you taking time out of your busy day.
Yeah, thanks for having me on. I think this is really vital information, because it's a hard time as a borrower, whether you're refinancing or buying a house. It's good information to know, so thanks for coming up with the idea. Yeah, and if any of you have any questions, again, my name is Jason Paull. I'm with Fairway Mortgage, and my information will be in the description below. Feel free to message me if you have just any one-off questions. There's never a silly question or anything like that, so happy to answer anything.
Well, thank you. And I'm Tim Olsen. I'm a real estate agent with John L. Scott.